Warren Buffett's investment advice is timeless. I have lost track of the number of investing mistakes I have made over the years, but almost all of them fall into one of the 10 buckets of investment tips given by Warren Buffett in this video. By keeping Buffett's investment advice in mind, investors can sidestep some of the common traps that damage returns and jeopardize financial goals. After much deliberation, I settled on my 10 favorite Warren Buffett investing tips in the list below. Each nugget of wisdom is supported by at least one of Warren Buffett's quotes and is helpful for investors seeking to find safer stocks. Let's dive into the video. Number 1. Invest in what you know and nothing more. Never invest in a business you cannot understand. Warren Buffett. One of the easiest ways to make an avoidable mistake is getting involved in investments that are overly complex. Many of us have spent our entire careers working in no more than a handful of different industries. We probably have a reasonably strong grasp on how these particular markets work and who the best companies are in the space. However, the far majority of publicly traded companies participate in industries we have little to no direct experience in. This doesn't mean we can't invest capital in these areas of the market, but we should approach with caution. Number 2. Never compromise on business quality. While saying no to complicated businesses and industries is fairly straightforward, identifying high-quality businesses is much more challenging. Warren Buffett's investment philosophy has evolved over the last 50 years to focus almost exclusively on buying high-quality companies with promising long-term opportunities for continued growth. Some investors might be surprised to learn that the name Berkshire Hathaway comes from one of Buffett's worst investments. It's far better to buy a wonderful company at a fair price than a fair company at a wonderful price. Warren Buffett. Number 3. When you buy a stock, plan to hold it forever. Once a high-quality business has been purchased at a reasonable price, how long should it be held? If you aren't thinking about owning a stock for 10 years, don't even think about owning it for 10 minutes. Warren Buffett. Warren Buffett clearly embraces a buy and hold mentality. He has held some of his positions for a number of decades. Why? For one thing, it's hard to find excellent businesses that continue to have a bright long-term future. Furthermore, quality businesses earn high returns and increase in value over time. Just like Warren Buffett said, time is the friend of the wonderful business. Fundamentals can take years to impact a stock's price, and only patient investors are rewarded. Finally, trading activity is the enemy of investment returns. Constantly buying and selling stocks eats away at returns in the form of taxes and trading commissions. Instead, we are generally better off to buy right and sit tight. Number 4. Don't follow the crowd. Here's another piece of Buffett advice that is extremely important for beginner investors, especially in the modern age of Reddit message boards. Don't buy certain stocks just because everyone else is. But also do not aim to always be a contrarian and sell the stocks that everyone else is buying. As Buffett does, the best way to invest is to ignore the crowd entirely and focus on finding value on your own. He also says, the most important quality for an investor is temperament, not intellect. You need a temperament that neither derives great pleasure from being with the crowd or against the crowd. Number 5. Don't fear market crashes and corrections. The obvious goal of stock investing is to buy low and sell high, but human nature can compel us to do the exact opposite. When we see all of our friends making money, that's when we feel like we should put our money in. And when stock markets crash, it's our nature to get out before prices drop any further. Buffett loves it when stock prices drop since it creates opportunities to buy at a discount. If you were shopping at your favorite store and suddenly learned that the entire store's prices were 20% lower, would you panic and run away? Of course not. Buffett embraces discounts on his favorite stocks and says, opportunities come infrequently. When it rains gold, put out the bucket, not the thimble. Number 6. Investing isn't rocket science, but there is no easy button. Perhaps one of the greatest misconceptions about investing is that only sophisticated people can successfully pick stocks. However, raw intelligence is arguably one of the least predictive factors of investment success. It doesn't take a genius to follow after Warren Buffett's investment philosophy, but it is remarkably difficult for anyone to consistently beat the market and sidestep behavioral mistakes. Equally important, investors must remain aware that there is no such thing as a magical set of rules, a formula, or an easy button that can generate market-beating results. It doesn't exist and never will. You don't need to be a rocket scientist. Investing is not a game where the guy with the 160 IQ beats the guy with the 130 IQ. Warren Buffett. Number 7. Look for a margin of safety. Prioritizing a margin of safety is a cornerstone of Buffett's investment philosophy. In simple terms, a margin of safety refers to characteristics of an investment that help to protect investors from losing money. For example, if a stock trades for $10 per share, but that company's assets are realistically worth $12 per share, then there's a $2 margin of safety. The intrinsic value of the assets should prevent the company's stock price from declining too significantly. Buffett's goal is always to pay less than a company's intrinsic value. As he says, a too high purchase price for the stock of an excellent company can undo the effects of a subsequent decade of favorable business developments. Number 8. Learn the basics of value investing. Warren Buffett is widely considered to be the world's greatest value investor. Value investing prioritizes paying low prices for investments relative to their intrinsic values. A value investor's goal is essentially to buy $100 worth of a company's stock for less than $100, ideally much less. Value investors seek out and invest in companies with intrinsic values that are well above the enterprise values implied by the prices at which the company's stocks trade. Value investors like Buffett expect that the market will eventually recognize the full value of a currently undervalued company, resulting in an increase in the company's stock price and a profit for the value investor. Number 9. Only listen to those you know and trust. Throughout his shareholder letters and occasional interviews, Warren Buffett emphasizes the importance of only investing in trustworthy, competent management teams. Simply put, Warren Buffett is very careful when it comes to selecting his business partners and managers. Their actions can make or break an investment for many years to come. Warren Buffett is obviously far more connected than any of us, which certainly helps him learn who the best and most trustworthy management teams are in a particular industry. While we lack the resources to really evaluate the character and skill of a public company's CEO for investing purposes, we can certainly control who we listen to when it comes to selecting our investments and managing our portfolios. The financial world is filled with many characters, good and bad. Unfortunately, a number of folks realize they can prey on investors' unrealistic expectations and feelings of fear and greed to make a quick buck. Number 10. Know the difference between price and value. Price is what you pay. Value is what you get. Warren Buffett. Those who invest in the stock market often try to resolve the difference between a stock's value and its price. Many moves can depend on these factors. You know that value and price are two different measures arrived at by different means if you've spent any time investing in the stock market. A stock's price is often at or near its value, aside from daily changes due to a rising or falling market. But it can happen that a stock's price, or the amount at which it trades on the open market, is quite different from its value. A stock's trading price is the number that an arm's length, willing seller and a willing buyer would find to be agreeable to each party. Investors need to distinguish between price and value, concentrating their efforts on high-quality companies trading at the most reasonable prices today. This is it for today's video. Thanks for watching and don't forget to like and subscribe my channel for more amazing videos like this.